also absolutely interesting, as we'll see. We try to see how do we analyze the output volatilities, the variations. We realize before the crisis and after the crisis, only 4 years difference. The element that contribute to output variations changes quite dramatically. In the emerging market, you will see the gray area. This is the pre-crisis. This is the pre-crisis. This is the post-crisis areas. The gray area is very it's the external impact to the exogenous contribution to the output variations. You will see from the emerging market, it's really changes from roughly 30% to 60%. That means roughly 4 years ago, the emerging market GDP output variation can be expanded 30% by external shocks, most of them from the advanced economy. Today, 60% can be explained by the external shocks. The same thing happens in the advanced economy. In advanced economy, it's smaller, but change is big. You see, before the crisis in the advanced economy, it's only 20% external shock explain the output variation. Today, 40% more. The reason is very simple, because the whole world is so interconnected to themselves, and everybody's the economic activities has impact positively. Oh, thank you, the lights are dim, and or negative impact on the whole, the other countries or neighbors. So this is the number is really changes we see. This is another interconnectivity issues as very issues. Also, there's issues that this is the second, the very strong, stronger intercorrelations. And the third change is the financial sector become ever bigger. This is the United States. If you see this asset size, you will see this is the banking sector. They change, but not very much. This is the investment banking sector. You will see investment banking sector assets increase dramatically in terms of percent of GDP, roughly from just 30 years ago, from roughly investment banking assets in terms of GDP from 2.5% of GDP increased to 30%. So in 30 years horizon, investment banking assets increased more than 10 times. So financial sectors really grow strongly. This is the assets are increasing in Europe. But this is another example for the cross-border, the financial sector expansions. You will see, we take just the European financial institutes who hold foreign assets. That means they hold the foreign assets across the boards. You will see just 10 years ago, they roughly only hold 2.7 trillion US dollar overseas assets. In 6 years horizon, in 2007, the European Bank aggregated, hold them together. It's roughly 8 trillion dollar foreign assets. Because of the crisis, they dropped 6.1 trillion still. So this is the foreign assets they hold in 2007. This is they hold in 2010. This is they hold in 2001. So you will see the cross-border foreign assets holding increase dramatically. This is obviously another big issue related with capital flow. This is various issues that hold on the dollar sense, emerging market, and a few others. I don't have time to expand into the details. And the banking's leverage ratio is still high, and I'm going to say a few things. When financial expanding dramatically, the global liquidity increase also dramatically. only during the financial crisis, in roughly 3.5 years horizons, the G4 central banks, US, UK, Japan, and ECB, aggregated increased the balance sheet roughly up to $6.4 trillion today. In terms of GDP, you will say US central bank's balance sheet is roughly from 6% of GDP increased to 18% of GDP. It's really increased just from 2007 to today. Roughly 4.5 years horizons. And the UK, the central bank's balance sheet also increased almost 4 times, from 5.5% of GDP to 20% of GDP. So, this is the UK curve. The red line is the UK. You will see from here, jump increase the UK in terms of GDP's levels. And also the ECB's yellow line here is not all clear to see. The top line is the Japanese bank, BOJ. So you see the balance is really increased dramatically. It's also, you see the change in the emerging market, because when the advanced economy print the money into the system, the emerging market responds to that, also take the foreign reserve, also putting the money into the system. So emerging market central banks' balances also increase dramatically. So it's here you will see the lower level is very much a Brazil level. Brazil is a blue or line. You see go that way, and very much and also increase very dramatically. And China, particularly at the top, it's not all clear. You can see here. Can we see China? Sorry, we cannot see China because of the light issue. The Chinese central bank balances increased from 40% of GDP to 80% of GDP. So also expanding dramatically. And the Brazilian central bank's balances roughly from 12% of GDP increased to 30% of GDP. So all the liquidity increase in a quite a dramatic way, which obviously another reason for the global capital flow as well. And the assets, the financial assets in this market also increased in a very dramatic way. It's just from 95 to 2009, the table you can see, really in terms of GDP, from 103 to 173%. So the whole assets increase in a very dramatic, increased 70% of GDP totally. So this is a very big increase. Liquidity increase, assets increase, obviously those form the base for the capital flow as well. Then come to the big change of the shift of global economic structures. Last year, the first time, the developing economy and the emerging market accounted for 49.1% of global GDP, PPP measured still. But they account only 19% of global financial assets. So obviously you can see the imbalance between two things. And because the crisis is the first time we observe in the emerging market have a lower government debts, have a lower and the government deficits, has a lower unemployment rates, but have a high interest rates and very strong growth. Rather, in the advanced economy, the first time we observe they have a high government deficits, high government debts, high unemployment rates, and lower interest rates and weaker growth. The money chasing profits, the money chasing growth, the money chasing high interest rates. And given the unevenness of global financial assets, locations, positions, obviously the money is moving away from advanced economy to the emerging market. It's because the light is not all clearly reflected the things I think I'm going to ignore the few pictures because it's all get into the detail. This is a chart we will see the return in the emerging market is much higher than the advanced economies in roughly 4 years horizon from 2007 to 2011. You will see the highest yield, the first bar is for gold. The return is the highest for gold. But the second one is very much emerging market bonds and indexed bonds, and also the emerging market global derivative, the second one. The third one, then the rest of the negative returns from other equity markets in the advanced economy as well. So the returns are very big. The reason, because I say the emerging market has a much stronger economic performance as well. And the emerging market, as I said, contributes much more to the global growth. Last year and the year before, emerging market contributed more than 2/3 of global growth. And also contributes more than 2/3 of global consumptions. This is also mentioned. You will see the emerging market has a much lower debt than the advanced economies. You can see this is brown, yellow or brown. This is the debts for the G7, which is advanced economy. This little red one is BRICS. It's 4 emerging major countries. And the little gray one is for all the emerging economies as well. So you will see roughly over 2005 and to the 2011, which is the middle, which is our forecast in 2017. In 2017. So this is from 2005 and it goes through the 2017, because it's hard to see. Yeah, it's hard to see the years behind because the light. And you will see for the advanced economy, the debts can only be stabilized in the top, in the 2015. In 2015, they will be able to stabilize roughly the total government debts in terms of GDP is 115%. This is way, way high. And the emerging market debts actually is on downside, and because they have a very strong GDP growth rates. And the BRIC debts is even lower. And this is also the debt issues. I'm going to move. And given the current situations and advanced economy facing more risks in terms of the growth and in terms of financial fragilities as well. So bring these two things together, I think it's become ever clear. The money is moving emerging market or advanced economy toward emerging market. It's also a big changes. And the global imbalancing is another drive for the capital flow as well. So if I pulling them together, we'll really see a changing world. The world is very different from the classical world that we thought, we believed before. The world is ever interconnected through trade and financial channels. The world is clustered themselves by 3 different groups, regardless of where you sit in geographically. And the liquidity is ample, and the financial connection is much more strengthened, and the market movements is more show the features of co-movements. The correlation among the market is much more strong here today than any time before. We even observe the market move. Some markets move never have a correlation before, now move together. For example, the currency market and the credit market. For example, the bonds market and some derivative market. They never work together, but they issue the co-movements. So the co-movements across the region in the same class of assets, and within the region for the different class of assets. And they more or less move into together. And the financial assets increase, obviously, and another big issues. And finally, the most important thing is the global economic structure shifts and moving the growth gravity away from the advanced economy to the emerging market and provide a much stronger drive force for the capital flow move into the emerging market. So I think this is a changing world, and a few things related with the topic we're going to talk is the capital flow. I just summarize some observations for you here. Now the capital flow. How is the capital flow look like? If we're looking for the capital flow, there are a few things also very clearly showed. The first issue, this is the capital flow to the advanced economy. You will see overall the capital flow to advanced economies increase, and 2008 crisis have a big drops and a rebound again. The left is a growth, and I'm not sure your left or your right, I'm sorry. So I just say this way. So toward me, and this is the net. So you will see the net also increases dramatically in roughly, this is from 1980 from forwards, roughly 30 years. So capital flow increased dramatically, and this is one way. If you're looking for the emerging market, the capital flow to emerging market also increased dramatically. But more interesting, because the picture toward me is a net. We'll see in the past few years, more and more, the net capital flow into the emerging market is very much, if I can go back, equivalent to the net capital flow to the emerging market. And it's never happened that way. So this is the first issue. The global capital flow obviously becomes stronger and stronger. That's the capital flow, net capital flow to emerging market for 1980 to 2009. You will see it's getting more obvious, very bumping around. So the classical capital flow feature is one is getting stronger and stronger, bigger and bigger. The two is very volatile. It's very volatile because the risk, because the policy different, the region difference. So it's very volatile. You can see suddenly 2007 it goes very strong, and 2008, 9 drops and rebounds. So this to the you will see this is another way the capital flow to the emerging market and developing countries is net capital flow. Right? The top is roughly $600 billion US, and but it drops almost to 100 billion. It drops 80% more than that. And during the crisis, then rebounds. So you will see it's a very volatile capital flow. It's also a very important feature for the capital flows. But meanwhile, with the capital flow in the emerging market, the reserves accumulate dramatically. You will see from 2000, roughly in 10 years horizons, the emerging market, the reserves from less than $1 trillion to $7 trillion. I will come back to this chart because this is an absolutely amazing chart when you go through to see how those things happens. Because, as I said, although the emerging market low-income countries share 50% of global GDP, they have only 19% of global financial assets. When the money moving away from advanced economy to the emerging market, the size is very different. 5% assets moving away from advanced economy to the emerging market, equivalent to the 30% emerging market size. So that's the third features. The capital flow have a huge impact on the emerging market, because in the emerging market is still relatively small and not very deep, and the product